but we're trying to build our firm as we're building our strategy for the long term. And partnership is an incredibly important part of that. I think the rest of it is, staying authentic and true to ourselves. And what I mean by that is, we are young, we lean into that, we're scrappy, and we love that. We're really hardworking, we're honest, and we think about honesty as general, but also intellectual. It's the deeper analysis. It's how do you take all that information and actually come to the investment decision. And the art, I think, is where differentiated thinking comes into play. And so how do we execute the art? So we are fundamental value investors at our core, but what we've chosen to do is take a modern approach to it. And so, or another way that we like to talk about it is value investing with a twist. So what does that twist entail, right? We use additional frameworks and analyses in order to better our investment process. They could be the dominant leader in e-commerce, and maybe in payments, they are in a strong duopoly, right? Either of those scenarios could play out in 10 or 15 years. The only thing we're confident in is that Mercado Libre will be some sort of clearish leader in these spaces.
Dear viewers of Good Investing Talks, it's great to welcome you back, and it's great to welcome Lucy Chou of Luna Partners for the first time. She's an emerging manager. She started with her firm in late 2021. And for the beginning of the interview with Lucy, maybe I want to start with the firm name. So Luna Partners, does it have a deeper meaning, or is it just a firm name? And hi, Lucy.
Hi, Tillman. Thank you so much for having me. Yeah, so I love our name. It's actually the combination of my name and my partner's name. So my name is obviously Lucy. My partner's name is Nate. So it's the first two letters of my name and his name put together. And then, we also love the fact that it's celestial, right? It's the Latin word for moon. And we're big fans of space. My partner is like an amateur astronomist. So I think it combines our names, shows partnership, and then has this deeper meaning of moon.
So investors can go to the moon with you?
Yeah, that would certainly be the hope and the dream over the long term, yeah.
What is your why for starting your own firm? So when I looked at your CV on LinkedIn, you had Merrill Lynch, Goldman Sachs, Stockbridge investors, just small, pure firms you worked with. Why is it why haven't you kept going on building career there? And why did you choose the more painful part of being an emerging manager?
Yeah, it's a great question. And it's something, I've given a lot of thought about, because to your point, right, I certainly could have just continued being an investor at someone else's firm. And I think about this answer sort of in two ways. First is the investment strategy and philosophy that we have built at Luna. I think, what we have built is really unique, and being able to build it from the grounds up really allows us to create a strategy, a process that's entirely our own and differentiated. And then the second part, which I think is equally as important, is building a culture and a firm that feels very authentic to who I am and who my partner is. I think, working at some other firm, and, I've worked at amazing firms with incredible people, but creating your own firm is an entirely different bucket, right? You have to build from the grounds up every aspect of it. And so that was really important, to have a firm that felt very, very authentic to who I am.
What didn't feel authentic at these other places? You don't have to dump them, but you also seem to be building something against some of the things you learned in the industry or these other places.
Yeah, look, I know, to be clear, I loved the firms I worked at. I think they had incredible people, incredible values. I think it really is two things. The investment strategy aspect I talked about, and I'm happy to go into more details of exactly sort of the modifications that we've made to traditional value investing, which I think are quite differentiated. But I think on the culture part and what feels authentic to myself, I do feel within Wall Street there is at times an archetype of what an investor should look like, or what a fund manager should look like, right? And I think the easiest example of that is by gender, right? Most people who work in this industry are male, or most fund managers are male. And I think, it's not necessarily that there was anything negative about the firms I worked at, certainly not. It's more, I didn't want to fit in a cookie cutter type box. I didn't want to meet certain expectations, to look a certain way, to be a certain way. And I think, by building my own firm, I didn't have to compromise any part of myself.
You already mentioned the differentiator or the wish to be different. So what is it,
Yeah.
what makes you as an investor and your firm's culture different?
Yeah. So I think the way I think about it and the way I think about investing is, investing is an art and a science, right? The science aspect is information gathering, it's technicals, it's valuation, it's the first stab at analysis. The art is putting it all together. It's the judgment, it's the deeper analysis, it's how do you take all that information and actually come to the investment decision. And the art, I think, is where differentiated thinking comes into play. And so how do we execute the art? So we are fundamental value investors at our core, but what we've chosen to do is take a modern approach to it. And so, or another way that we like to talk about it is value investing with a twist. So what does that twist entail, right? We use additional frameworks and analyses in order to better our investment process. Some of these examples would be, we've developed an internal 4 business model framework, and we only invest in opportunities that fall into one of these 4 categories. And I'm happy to talk about that in more detail. The second is how we source. We source from the conventional methods, like top down, bottoms up, from colleagues, from other funds, from letters, but we will also source from unconventional ways, Reddit, social media, or my partner watches documentaries. Sometimes ideas fall out of that, or we will talk to friends outside of finance to see what products or applications or businesses they're using, or even what I personally will use. And I think the point here is to source from everywhere, and the idea that good ideas can come from anywhere and to not sort of fall into, the conventional echo chamber. I think another modification, which is probably the largest modification we make to conventional value investing, is the incorporation of behavioral finance factors. And it's based on the premise that things are worth what people are willing to pay for them, right? And so we spend a lot of time thinking about other market participants and what other market participants are underwriting. And it can fall into the quantitative bucket, where we will consider trading momentum, technicals, ownership trends, even trending of Wall Street estimates, with the idea that, if we love a business and the long-term fundamentals are amazing, but price momentum is against us, we might start that position with a very small size, or we might wait until momentum turns and then invest. And then the second bucket of behavioral finance considerations is more the fundamentals, the qualitative. And so this is where we really ask, what is the market choosing to underwrite or not underwrite that we are underwriting? And so we're trying to think like, are we calling the market winner early when there are still a lot of competitors and the rest of the market is not doing that? Are we underwriting higher pricing power for a company or greater margin expansion in the long term versus the rest of the market is not yet convinced of that? So that's sort of the type of fundamental behavioral finance considerations that we factor in. And our belief is, just to be clear, like we still are fundamental value investors at our core, but we believe these additional modifications and frameworks allow us to, over the long run, come to better and repeatable investment outcomes. So I would say that's sort of how we've differentiated ourselves on the investment strategy side.
So you try to understand Mr. Market, but Mr. Market is also manic depressive. So it's a bit of a challenging way. How do you stay sane when trying to understand such a figure?
I mean, that's the thing. I think that's also part of the reason why we initially decided to start incorporating behavioral finance factors, right? Because I think with value investing, in its purest form, investing in the market can drive you crazy, because a lot of times you'll start feeling like, oh my gosh, this is such a great company, but the share price keeps going down, or the market or the value is never being realized the way that I see intrinsic value. And so we're really honestly trying to take some of that frustration out, where instead of sort of banging our heads and being like, why isn't this happening? We're trying to understand, why isn't it happening? And like, can we maybe around timing and sizing invest in a better way where we incorporate some of those considerations around other market participants?
So it's also self-therapy in this insane setup to a certain level.
Absolutely. I mean, it's really, look, investing is about learning about the world. It's about being really curious and thoughtful, but it is also about trying to understand what other people are thinking. And I think when you start I mean, I love it. I think it's really fascinating to try to understand other people. And this is sort of a grand scale way of doing that.
That's surprising because most investors just see numbers and there's no other people involved in these trades.
Yeah. That's a fair point. Yeah.
Coming back to your firm, which goal do you try to achieve for you and your client base?
Yeah. I think we like to be quite explicit about what we want to target. And so I think when you look at the US markets over long periods of time, that's typically returned on an annualized basis, high single digits, 9-10%. And then we looked at sort of, the best long-term value investors that we could think of. And they typically were able to annualize at a mid-teens to 20% target. And so our target starting this firm was, we want to be reaching that 20% target or higher, right? And so every investment opportunity, when we think about investment strategy and the process we're building, our intention is to have them have the potential to reach that 20% or exceed it. And so the way we do that is, as I mentioned, we do this sort of fundamental value investing with a twist. And we believe our alternative or modern modifications will help us achieve that. So that's what we're trying to bring to the client in terms of investment returns and strategy. The second aspect, and we talked about this a little bit, is about the culture in the firm that we're trying to create. And I guess just to give a little more detail on that of what we want to bring, right? Because that can mean many things. For us, I would say the first and most important thing is partnership, right? I think, we talked about this, but even within our name, it's a combination of mine and Nate's name. Our partnership is key, but it's not just partnership between us, right? We think about our clients as partners, vendors, colleagues, anyone we interact with. We want to be building a long-term partnership, right? We're not trying to do these sort of impersonal, transactional-based, short-term relationships, but we're trying to build our firm as we're building our strategy for the long term. And partnership is an incredibly important part of that. I think the rest of it is, staying authentic and true to ourselves. And what I mean by that is, we are young, we lean into that. We're scrappy and we love that. We're really hardworking, we're honest, and we think about honesty as general, but also intellectual, keeping ourselves accountable and knowing that, we have no other incentive or alignment or bureaucracy other than sort of 100% focused on becoming better investors and getting to better outcomes for our firm and for our clients.
To follow up on this, how long are you in the investing game for? Is it like you say we're 50, we want to do something else? Or are you more in this Buffett model of like, you have to carry me out of here when I'm dead?
Yeah, I definitely think the latter. I mean, we always joke about this, but, Nate and I both recognize how lucky we are and privileged we are to be doing this incredible job so early on in our careers. But we always say, like, this is hopefully, forevermore our last and final job. This is the last, if we can, we want to be building our firm for decades to come. And this is the only job I want to do. And I think it's an incredible job. Sometimes when I really think about it, it's pretty amazing to have a profession where, especially our strategy, right? It's sort of inherent in our strategy as a long-term value investor, where what you're essentially doing is just getting the ability to learn about the world, right? Trying to envision in 10 or 15 years how the world will look. And especially as a generalist, I get to learn about everything. And so that's pretty amazing that is a job, just to learn. And sometimes it's just learning for the sake of learning, which is amazing. So yeah, hopefully I can be doing this for the rest of my life.
Before we jump into your research process, we already talked about a bit, maybe a question about the outside world of investing for the viewers of this channel. It's hard to believe that there's something else outside of investing. But what are important things you have achieved outside investing, or is there anything you would even label as an outstanding achievement you can share with us to learn more about you?
Yeah. I think that's tricky because I would say the most important thing in my life, maybe hand in hand with investing, are my relationships. And so I'm really, really passionate about being a good friend or a good daughter or a good wife or a good sister, or even, hopefully in a few months, a good aunt, right? So I also think that, and this is a very common thing where I think, I'm in my late 20s, early 30s now, and I think, as people get older, people start moving away, right? I feel like in this stage of life, all my friends, my family, everyone's starting to move to different cities or different locations. And I think one of the things that I'm really, really concerned, but also passionate about is staying in touch and maintaining those relationships, because life is sort of taking a different route for everyone right now. And so I would say, as weird as an achievement, I don't know that this is necessarily achievement, but I'm really passionate about being on top of my relationships, and like those are the most important things to me. Yeah.
And are there any things outside of investing that keep you pushing even harder to achieve success in your profession? So with Buffett, for instance, it's this relationships he has in Omaha where he is kind of like also saying, I just do this to make my friends in Omaha rich and support the people who trust me, and this trust fuels him further. So is there anything like this for you?
Yeah, I mean, I think it's a few things, right? Like, one certainly is, the trust that our clients and that my family have put in me, right? So I think it's like a very similar thing to what Buffett is saying is, so many people from my family, my friends, my old colleagues who've mentored and supported me. I think a lot of people have helped me along this journey, and that certainly helps fuel me. I think also part of it is just innate, right? It's a desire, like I love investing, but to do what I want to do with the rest of my life, it's really, I very much don't view it as a job. It very much feels like a calling or a passion in life. So part of it is innately driven. And then I do think there's maybe like a third aspect, which is, realistically, right? And I don't want to make this into a whole thing, but, finance has historically been, a male-dominated field. And I think, I've had incredible mentors, and it's been such a privilege to get, the things I've gotten. And I think, there is something nice about thinking, even now to this day, I'll talk to students from my former college or high school, and a lot of young women will reach out to me. And I think that's really important to sort of keep that process going, if that makes sense, because I've had incredible sort of female mentors who have helped me along the journey. So there's probably this third aspect that is being driven by sort of maybe this external knowledge that, being where I am I shouldn't take it for granted, I guess, is my point.
So there's also a bit the role model, Lucy, to a certain level.
I mean, I don't know I would go so far to say role model, as I think I'm still quite early in my journey. And, I'm still trying to figure out a lot of things. And so I wouldn't necessarily say role model, but I'd say, certainly like where I've been able to give advice, or where, someone can look at me and be like, oh, that's cool that she's doing it. Maybe, that's something I'm interested in too. I think that's incredible.
Hey, Tinlan here. It's great that you've made it that far into the video. And I think it shows a certain passion for investing you're having. If you want to dive deeper and go further down the rabbit hole, you're invited to apply to my community, Good Investing Plus. It's a place that's very helpful to people who are ambitious about investing. It's helpful to investment talent as well as experienced fund managers. So if you're interested, please click on the link below. And now, without further ado, enjoy the conversation. So let's jump to the research part I've already mentioned. But before that, maybe can you elaborate a bit more on your style of value investing with a twist? I hope it's no arm twist. We played this too much with my cousins as a kid.
Yeah, so I sort of discussed it. So value investing with a twist, we've made modern modifications to value investing. And so that was incorporating the 4 business model categories, sourcing from anywhere and everywhere, and then incorporating behavioral finance factors. So I've sort of touched upon those, but maybe I'll go into more detail on the 4 business model framework, if that works. So when we looked at history, and when we looked at sort of our personal investing experience anecdotally, as well as research from investors that we admired, I think that there were a few characteristics that fell out that were common shared characteristics of companies that would compound at above market rates for extended periods of time. So we took those common characteristics and created 4 categories. And those categories are compounders, shooters, cyclicals, and transformers. So compounders are typically market leaders. We're looking for hopefully, natural monopolies, oligopolies, duopolies, that sort of thing, operating in relatively more mature markets, but with still steady growth. Given those industry dynamics, they tend to have really strong margins and really strong cash flow generation. And we also look for management teams that are, experienced, established leaders. Shooters are what we would consider, future compounders. They are earlier in their market leadership. They're in TAMs that are growing very, very rapidly. And their market leadership is not definitive, but it is early. There are early indicators of it. For example, there are early indicators of it. And because of those dynamics, they maybe aren't super profitable today, but there is a viable path to profitability. And so we're looking for early indicators of that, like good unit economics, future pricing power, or increasing spend efficiency. And this is a space where we like our leaders to be sort of visionary CEOs, like we love CEO founders. Cyclicals are companies that, they have a lot of the same characteristics of compounders and shooters, but they operate in cyclical industries. But we also recognize that, cyclical industries come with their own risks, and not every cyclical opportunity is a great one. And so we also look for additional characteristics in the industry, and timing is really important. So, for example, a recent demand shock with a delayed supply response, or, healthy levels of leverage in the industry, good secular tailwinds that are timed well, that sort of thing. And then transformers, our final bucket, are companies that are undergoing some sort of transformative action, which we define as, really large recent M&A, some sort of restructuring or turnaround story, with the idea that once they've undergone this sort of transformative action, they will become a compounder or shooter. I would say that what we have found is that when a company falls into one of these four categories, that's what we would consider a high quality business and something that would be worth consideration in our portfolio. We've also found that over the past few years, the types of opportunities that we're best well equipped to analyze and then come to an investment on is the compounders and shooters category. So that does make up the majority of our portfolio. We do still look at cyclicals and transformers, but they are higher risk investments, but also higher return opportunities. But just for those, we would demand sort of a higher level of conviction.
Can you maybe give an example for each category? So what's the Optimus Prime in a transformer space, or?
Yeah, so I would say, for a transformer, Boeing would be a good example of that, where, clearly a lot of recent issues, a lot of restructuring, but the intention is, a few years down the line, returning to be sort of a compounder. Cyclical would be Cleveland Cliffs, which is a U.S. steel business. We think it's a really high quality business, a lot of reasons why. So it operates in essentially within the U.S. There are 4 major steel companies. And so it operates in sort of favorable competitive dynamics. It's run by an excellent management team, but it is still a cyclical industry. Shooters, Mercado Libre is a great example of that, where, it's an early market leader and really, really rapidly growing TAM. We love that business. It's actually our largest position right now. For compounders, I think we have a few examples of that, but one would be something like Workday, which is really a clear leader in sort of the HR space. It's sort of a mix because it's a little bit of a shooter in the sort of the financial space. But I would say in its core business in HR, it's a clear market leader, mature market, growing well, solid management team that's been around for a while. Great business as well.
With your research process, what kind of aspect do you spend the most time on?
I think we spend the most time on thinking about the business and the industry. And what I mean by that is, we're making these long-term investments and bets. And so we're trying to think about where all of this will look and what the world will look like in 10 years and how the company's products will fit into that world. And so the best way we can do that is really understanding the customer, understanding the customer's motivations, the product and how it serves that, and then how the product will also evolve over time. And so I think to do that, you really have to deeply understand, the context, the different motivations, the company's evolution over time. And I think that's what we really focus on versus more near-term stats or financial metrics. That's still important, but for the long-term bet, I think really understanding the industry and context is more important and more critical.
And which 3 investment mistakes have improved your research process the most?
So I think, okay, I'm going to answer this in sort of a weird way because I think to your point, our mistakes have driven changes in our investment process. So maybe I'll start with the process changes and how that came out of mistakes. So I think first is the 4 business model framework that we talked about. I think when we initially started, we had a general idea of what a high quality business felt like to us, but it was much more in some ways subjective, right? We were just looking for, good TAMs, good management teams, strong growth, but what does that really mean? And I think that led to some early mistakes where being more crisp and defining quality more clearly has allowed us to really crystallize what we're looking for. Versus initially, I would say we invested in some relatively lower quality businesses, which were not the right decision for us. And so I think really crystallizing these 4 categories and more clearly defining them and what exactly we're looking for. That's maybe first. I would say the second, and this sort of goes hand in hand with that mistake, is the reason why we looked at lower quality businesses is because a lot of times they come with much higher return. And I think what we have come to realize is, no, there is a quality bar threshold that we will never dip below regardless of the return, right? That's just not what we do. We're not well equipped to understand companies that are lower quality. And I also think that this also sort of helped us crystallize our behavioral finance considerations, because in the beginning, similar to sort of the 4 business model framework and quality, we knew we wanted to incorporate behavioral finance considerations, but we were sort of vague about it. We were like, we're just trying to understand what market participants are thinking. But now we've really sort of categorized it into 1 is the quantitative factors and 1 are the fundamental factors. And I think this matters particularly around the value versus quality point, because I think in certain scenarios, right, as stocks get cheaper and cheaper, you think to yourself, this is a better and better buying opportunity. But what the behavioral finance has taught us in some of those scenarios, because we will factor in like price momentum, right, is that sometimes when the price is going down and momentum is against you, you don't necessarily want to invest, right? And that sort of runs counter to a lot of the foundational aspects of value investing, right? Which say, if long-term fundamentals haven't changed, if a stock goes down, it's great, it's cheaper, it's like a better opportunity. But no, we're realizing sometimes like the negative price momentum is you can fall into a value trap, or you're trying to catch a falling knife on the way down. And those are scenarios that we want to avoid, where you might get stuck in dead money or worse for extended periods of time. So that's the second. And then I think the third is just generally across our investment process, and also definitely applies to the first 2, is documenting, memorializing things. We've gotten a lot better of writing down everything we're thinking at a point in time, because it's really, really hard after an event has occurred to think back to what you were thinking about beforehand. And obviously, I mean, from the very start, we had, processes where we wrote things down, but I feel like over time, we've gotten even more religious about that, and really trying to understand when we get things wrong, why did it go wrong? When we get things right, how did it go right, and how can we replicate that? And I think it's really critical to our process because it helps us sort of stay accountable to ourselves, particularly as a small firm with only 2 partners, right? How can we really, really stay accountable to ourselves, to our mistakes, to our successes, and sort of how can our process evolve? Because we see our process as not a static thing, but something that should continuously be evolving.
So if you think about your process in 2 lines, 1 is showing up and 1 is showing a downward trend. Maybe go back 5 years. You started 3 years ago, but maybe you go back 5 years in your investing framework. What kind of aspects made this process, and what kind of aspects made this process, like going down and up?
And down and up is in terms of like time we spend doing them?
Time spent, or intensity of research, or what is important for you. You already mentioned this a bit, but maybe to outline your transition there.
Yeah. I think so we have kind of mentioned this, but I think, where we have spent the most time historically, but it only continues to grow more important, is around the quality of the business over the long term. So really focusing on the fundamentals and how, customer interest will evolve, how the product will evolve. Will this company serve its customers' interests in 5 years and 10 years? I would say where we spend a lot less time now, but this has been true from the start, but probably progressed even further is around metrics. I think when you're betting on things where you want them to do on 5 or 10 years, slight margin moves for a quarter here or there, or slight growth dips up and down in a quarter-to-quarter basis are not super important. We obviously have a long-term model, and that's how we pump out our returns. And we run triangulations, we do all the analyses, but and I mentioned at the beginning, I think that aspect of investing is not super interesting, right? It's mostly commoditized. Anyone can do evaluations and technicals. I think the real higher level thinking is sort of thinking about 5 or 10 years down the line. And so this smaller category, we still do it, but to me, it feels more of like a check the box thing. I think the only other thing though I would add, and this is sort of counter to what I've just said in a caveat, is when you are a really long-term investor, it's very, very easy to dismiss short-term movements or short-term volatility or missteps as like short-term noise. They're not important, right? And if anything, a lot of those times where like, let's say a company misses one quarterly earnings expectation, a lot of times that's like a great opportunity to buy. Having said that, you also have to be cognizant of the fact that is that sort of short-term misstep an indicator of a broader trend changing? That's the only thing that we're really, really cautious about when we sort of think about the short-term things. But for the most part, those don't worry us. And we have the privilege of that because we are long-term investors.
You mentioned already that Mercado Libre is your largest position. So let's talk about it. How did you get in touch with the company, and what was the initial dance you did before investing?
Yeah, so Mercado Libre is currently our largest position. It's about 25% of our portfolio. I guess just to give a little context, so it's listed on NASDAQ, MELI. It's about a little under 100 billion in US market cap. So I heard about the name, frankly, a long time ago. I think back at my old job, and that's sort of how it sort of initially sparked my interest. I've heard about it periodically throughout the years, but when I was starting Luna, that was sort of one of the first names that I immediately was like, it looked really, really interesting, compelling. Let's do a bit more work. And it's been an investment, I think, nearly since we've started. And since that time, it has only grown in position size.
And what was the dance you did?
Oh, okay. Yeah, sorry.
At the beginning, like the analysis dance, maybe the dance was a bit too short as a picture.
Yes. So I guess the dance we did was, so our initial process for looking into any business is quite similar, right? We start thinking, we look at the filings, the presentations, that sort of thing, and we're trying to understand at its core, what is this business? What does it do? What's the industry? I think what immediately struck out initially with MeLi is the industry context is incredibly important with a company like MeLi. It's dealing with a huge TAM with two major secular tailwinds behind it. So first is LATAM e-commerce penetration. LATAM e-commerce penetration is well below what it is in the US. It's typically been slower or behind for a handful of reasons, including lower internet connectivity, logistical infrastructure problems. COVID has obviously helped accelerate this. And you have also had companies like Mercado Libre who have poured billions into building out the infrastructure. And so that has helped a lot. The second is payments, right? LATAM economies have historically been cash-driven economies. And that's because, banking was inaccessible. There were incredibly high fees, low transparency, concerns around fraud. And similar to e-commerce, COVID has helped accelerate this. But in addition to that, you also have had the rise of fintech companies like Mercado Libre's product, Mercado Pago, which have allowed easier onboarding. They've had lower fees because at scale and with their software, and they also have a lot more transparency. And so what's really critical with Mercado Libre and what we've spent a lot of time thinking about is just the industry backdrop in the context of those sort of two major tailwinds. And then once we figured that out, our next consideration was, okay, so we have these awesome tailwinds. How does Mercado Libre sort of fit within that context, right? And so Mercado Libre is the largest e-commerce platform in Latin America, right? And there are many reasons for that, including, first mover advantage. They have incredibly strong brand recognition. They have incredible local expertise. They've been operating in the industry for over 2 decades at this point. They have tons of investment in infrastructure that I mentioned, in fulfillment centers. And then also, and this is really important, is the ecosystem of payments in e-commerce. That's incredibly valuable, right? It makes their consumers across both sort of platforms and all the offerings incredibly sticky, lower churn, higher engagement. They also have access to amazing data. So one of their big payments growth drivers is around credit, right? And through their marketplace, they have access to tons of credit data for their customers. And so they're able to use those to incorporate into their credit risk assessments and roll out loans and offer credit cards to their consumers. And so we sort of see this very much as a great case of a shooter, sort of, and from the categories that I just talked about. Mercado Libre is a great example of a shooter, right? You have this amazing TAM growing very, very rapidly with two main secular tailwinds that we really understand, we stand behind. We've seen them occur in other countries, and so we really see that being something that will happen. And then you have an early market leader with what we believe to be sort of sustainable competitive advantages. Margins, I believe, are in the low to mid-teens EBITDA margin right now. So it's not super profitable, but at the same time, we see really a viable path to future profitability. They have 50% gross margins. They've had increasing spend efficiency, and they have a management team that's sort of led by the type of visionary CEO founder types. It's Marcus Galperin, who founded the company back in 1999 when he was at Stanford Business School. And so we think it's an incredible business for all those reasons. And, we think it's a very reasonable valuation given its growth profile. And so, yeah, it's our largest position.
But generally, e-commerce isn't like the best business if there wouldn't be this growth. So you said you focus on good businesses. So how is in a not the best business where you have competition, where Chinese people can enter, where Temu can enter, where Shein can enter, where Amazon is always a threat? How do you make sure this MeLi is a good business?
Yeah, so that's a great question because, the competitive landscape is definitely one of the key risks for this company, right? I think what we have decided and spent a lot of time thinking about is how sustainable are the competitive advantages that Mercado Libre has, right? And we think they are sustainable, right? We think, we talked about a few of them, right? They have extreme local expertise. They've been doing it for over 2 decades. They have the first mover advantage and strong brand recognition, and they've just gotten the consumers in, and they're quite sticky. We see, the billions of infrastructure investing that they have put in. And I think one of the most critical is sort of what I talked about, the ecosystem between payments and marketplace. And I think once you have consumers who are using both payments and marketplace, they're incredibly sticky, and they have a lot of touch points with the company, and it sort of ultimately leads to lower churn and just higher engagement. And I think it makes really, really hard for other players to displace them. And I think you're seeing that to slowly come true, right? I mean, I feel like one of the biggest entrants that was quite noisy was, Sea and Shopee a couple years back. And, since then, they've sort of pulled out. We also feel like we see it within the metrics themselves, right? Mercado Libre sort of talks about how they don't really see any of their share declining. They, in fact, see their share increasing. I think you also see it just like broadly in their top line numbers. They aren't really slowing down in growth, but they're still able to grow despite the fact that you have these sort of noisy other entrants coming in.
And if you look under the hood with Mercado Libre, it's not an easy case to underwrite because it's an e-commerce play, but then it's also a fintech, so it's turning into a bank, and they offer credit card and lending is like tricky compared to e-commerce. So how do you make sense out of all of this?
Yeah, I think that's why, we spend a lot of time diligencing our companies, right? We spend, I mentioned weeks, if not months. Actually, most of the time, I don't even know I say weeks, but most of the time, months sort of trying to understand a company and an industry. And I think that also, to your point, right, allows us to see opportunities because particularly with more complicated or complex businesses, it takes time to really, really understand them and sort of be able to unlock that value. So I really think the biggest thing is around time and sort of the dedication to really understand a business well. And like in practicalities, right, the ways we do that are, there's like the obvious, you go through all the filings, all the presentation, you look at competitors, sort of all or most of the publicly available information out there. But you know what? We will also like look at blogs, we'll talk to experts, we'll read expert transcripts, we'll try to, like this isn't specific to MeLi, but just like any of our investments where we can like personally test the product, we'll do it. We'll even like talk to other people who have tried the product or all sorts of sort of experts in the industry, that sort of thing. Yeah.
But how do you dissect the financial institution part of Mercado Libre? That is not like falling into shades at a certain time if they give out that much credit?
Yeah, so they do not give out a ton of credit information. I've seen a couple of reports, like I know JP Morgan just put one out where they tried to dissect it, but you have to make so many assumptions that I don't know how reliable that ends up being. I think that is a really, really tricky part. And you know what, maybe this is a good time to discuss like one other type of investments that we try to categorize is, so there are some investments where, we're very, very detailed in the financials and there's a limited scope of sort of potential earnings outcome, right, in 5 or 10 years. And with those, being precise is helpful and, those can be great investments with great returns. And then there are other types of investments and Mercado Libre sort of falls in that bucket where the bet is not on precision, right? To tell you with any level of certainty in 10 years that e-commerce penetration is going to be, X% in 8 years or 10 years or 12 years is sort of ridiculous. Or even to tell you, and part of this is because Mercado Libre does not disclose a lot of detail about how, their credit does versus their other sort of fintech products, to tell you with any sort of level of precision exactly how their margin will play out over the next 2 years, 3 years, let alone 10 years is incredibly hard. And I think that's the wrong sort of bet because we would be precise without really being accurate. The bet with Mercado Libre is sort of a big broad strokes bet, right? Our bet is, look, you have these great 2 amazing secular tailwinds. They're going to play out. Whether it's doubling penetration in 8 years or 12 years, don't know. And then you have Mercado Libre, and we're calling them as a leader. So there are many ways in which it can play out. They could be the dominant leader in both e-commerce and payments. They could be the dominant leader in e-commerce, and maybe in payments, they are in a strong duopoly, right? Either of those scenarios could play out in 10 or 15 years. The only thing we're confident in is that Mercado Libre will be some sort of clearish leader in these spaces. And the reason why I bring this up is it helps us sort of think about what are the key risks and what exactly are we underwriting. Because to your point, right, it's incredibly difficult to model with any level of certainty 5 or 10 years out any company, but particularly a company like Mercado Libre, which has incredibly complex financials, incredibly different businesses, and also more important, maybe not more important, but equally importantly, right? They're very early in their journey and there are a lot of dynamics at play. I would also note, like Mercado Libre, they don't give out any financial targets, right? From what I remember, they don't even give out next quarter or a year from now. So it makes it incredibly difficult to forecast for them. But the way we think about it is it's a big, broad strokes bet. And just to be clear, not all of our bets are like this, right? There are other bets where we have very, very precise, detailed models and we track very closely certain KPIs. They're just different types of bets. And a little bit, I love this passage from Security Analysis by Graham and Dodd, where they talk about how security analysis is not always about knowing exactly what intrinsic value is, but it's about knowing that intrinsic value is just adequate to make the relative to market price to justify the investment, right? And in layman's terms, like you can look at a man and know that he is overweight without knowing his exact weight. Or you can look at a woman and know that she is old enough to vote without knowing her exact age. And in this scenario, as long as we get the broad strokes big bet with MeLi correct, the returns work out. And so we obviously still have a very detailed model and we do lots of revenue triangulations, lots of margin analyses and sensitivities. But for MeLi, it certainly for us is a different type of bet. And it also sort of speaks to the risks that we monitor. So for MeLi, we're more focused on like watching the trends and making sure, is there a structural reason why, e-commerce penetration or the rise of digital banking will not happen the way we think it will eventually, right? Is there a competitor coming up who's going to suddenly take a ton of share or sort of hinder MeLi's growth over the next 10 years, right? That's sort of what we are watching out for. Versus there are other types of bets where, we're much more closely tracking certain smaller financial KPIs, if that makes sense. Yeah.
It does. As a final question on MeLi, what role does analysis of management play for you with this case, and then maybe also in general? We didn't talk that much about management.
Yeah. So, I mean, management's really, really important, right? Because it's ultimately comes down to their execution. There are definitely scenarios where we feel it's more important on a relative basis, and that would be, transformers, for example, within our 4 categories. That's where it's really, really critically important because they're going through some sort of transformative action. The execution is really critical. I would say it's still important when you're looking at a compounder, but maybe less critical just because those are established, mature winners and good fields. And so like the leaders we're looking for there are more like we want experienced, solid leaders. Do they need to be the best of the best and the most like forward leaning? Maybe not. Versus, when we look at shooters, which is the case with Mercado Libre, we're looking for visionary CEO founder types who like they live and breathe by their company, right? We don't necessarily love CEOs who jump around from spot to spot. I think that's maybe a CEO better suited for like a transformer if they're really good at executing a very specific thing, and that's what they do from company to company. For Mercado Libre, and I mentioned this, their CEO is Marcus Galper, and he's the founder since start. Really brilliant, really smart, and I think he's incredibly long-term focused. That's the other consideration for us. And what I mean by long-term focused is he's making a lot of investments today that maybe hurt his P&L, but I think over the long run will pay out. And so when we think about him, right, he sort of falls into our thesis, our bet on Mercado Libre, right? Because we don't care about him sort of managing his margins or managing his P&L today. We care about him making the investments that are critical to set himself up for like 5 or 10 years, right? For a company like Mercado Libre, they can worry about margins, in my opinion, in 10 years when they are the leader, and there's plenty of time to do that. And so that's sort of how the general framing of how we think about management teams, yeah.
Let's sum up the interview, or let's close the interview with the topic portfolio construction. How does MeLi fit into your portfolio, and what kind of role do the other 4 categories play? Do we have buckets, only 10% transformers, or yeah?
So we use a investment frontier. It's based off, the efficient frontier in economics. But we use an XY chart, and we essentially map 2 things. The first is an IRR. So we look at 3-year and 5-year IRRs, and that's just off of our base case model. The second input is a quality score that we come up with. So the quality score is subjective, and it's sort of an output of all of the diligence we've done, and it speaks to our perceived quality of the business. But not only that, it also speaks to how much could we have diligence the company. As in, like, if you had a business that we thought was like, oh, this is probably a really, really high quality business, but we can't diligence it for whatever, or was not diligenceable, then it brings the quality score down. And so you sort of map those 2 things with all of our companies, and also companies on our watch list, which are interesting companies, but not quite in our portfolio yet. And the idea is to have as much stuff sort of, most of our portfolio is composed of things sort of out to the top and to the right. In terms of diversification, so I sort of mentioned this, but most of our names are compounders and shooters, right? I would say 60 to 70% of our portfolio over periods of time have been compounders and shooters. I would say transformers and cyclicals make up the rest of that. We do not have hard and fast rules in terms of size, sector, industry. I think what we're more interested in is diversifying by tailwind. And so we try to think about the key tailwinds impacting our companies and making sure, they don't overlap too much. And also, we want to be concentrated, right? We own 10 to 15 names. And so, if there's a tailwind that we love, we want to pick 1, maybe at maximum 2 names that we think will benefit the most. And then obviously, just like on a practicality purposes, we do look at correlations as new names come into our portfolio against our existing portfolio. But we don't have any sort of hard and fast rules. That's just sort of a sanity check for us. So that's sort of how we think about portfolio construction.
And how did Mercado Libre grow into this 25% position of the portfolio? Or not even grow, was it like recently bought to
Yeah.
the high stick?
I think it both grew, and we have bought more as, our conviction in the company has grown, and we've also underwritten the model up a few times just as it has outperformed. I think, it's always been a big position for us from the very, very start. We've always had a lot of conviction in, but just, recently, I think a combination of opportunity to buys and also its performance over the past year has had it grown. It is one of our, I would say it is maybe our strongest conviction name, and mid to high level return based on our IRRs. So I think that makes it a really, really compelling investment to have it be our largest. The other thing I would add is, for example, this most recent quarter, they had an earnings miss, but they, met expectations on top line. And because of that, the share price dropped 15% on that day. We looked at that, and we very much felt that was sort of a short-term margin issue that was not important to the long-term fundamentals. We also felt like, the stock had been performing well over the last year or so, and so we took that as an opportunity to invest more. So that certainly has helped grow the position a little bit, but we did have a very sizable position before that as well.
And thank you very much for the great interview and your insights. For the end of the interview, there's always the chance to add anything we haven't discussed or discuss a question we haven't touched. So do you have something to add?
So thank you so much, Tillman. I really enjoyed this chat. And also I just wanted to say, your good investing community, what you've built and created is pretty phenomenal and amazing. And everyone I've chatted with through it has been incredible. Second, if anybody watching wants to follow along, we have a newsletter on our website. Please feel free to join. And then the final thing is just, and I sort of mentioned this earlier, but I'm very early on in my career, and I recognize that there's still a ton for me to learn and figure out. But at the same time, if anyone's watching, whether you're in college or just out of college, and want to chat about anything, starting a firm or, advice around banking or public equities, definitely feel free to reach out. I've certainly benefited and been privileged to have a ton of amazing people above me do calls and coffee chats with me. So definitely, if you're interested in chatting, reach out. I'm available on LinkedIn or via my website.
Thank you very much for the kind words. And the link to the website is below. So it's just one click away. Thank you very much. And bye-bye. Also, bye-bye to the audience. I really hope you enjoyed this conversation. If you did, please leave a like and a comment, and for sure subscribe to my channel. Traditionally, I want to close this conversation with the disclaimer. So here you can find the disclaimer. It says, please do your own work. This is no recommendation. What we are doing here is just a qualified talk that helps you, but it's no recommendation. Please always do your own work. Thank you, and hope to see you in the next episode. Bye-bye.